And so we will look at a recent question that investors have asked about the value factor. So if you think about factor investing, the value factor is really, sometimes referred to as the mother of all factors. So, you could list your popular set of factors, including things like momentum, profitability, low risk. Value, typically will be in this set of factors. It's clearly one of the factors that has been documented very early on. A key reference is a 1985 paper by Bar Rosenberg and others. So already in 1985, there was this evidence published in Journal of Portfolio Management that stocks with a high book value relative to the market value will actually tend to have higher returns. We can go back 35 years. We already had evidence. Since then, in the academic literature, the value factor is clearly included in all of the workhorse multi-factor models. So these models have been extended, new factors have been added, but really all of the workhorse models do include a value factor, and that value factor again is based on price to book. So price to book is the very common value definition. Of course, also in industry applications, value has been around for a very long time. So even in the 1990s, when there weren't yet any factor indices, we already had value indices. So value was seen as an investment style. And again, here a common definition of value is the price to book. Now, this value definition has been questioned recently, and many have argued that this value definition is actually outdated. Okay, so book to price is no longer a relevant measure of value. So here we will look at this question, and we'll try to see whether really book to price is an outdated value definition, or whether it is still relevant. So what is the key argument behind this criticism? So the key argument behind this criticism of book to price is that the book value of a firm doesn't actually capture a lot of the assets that the firm has. So clearly, book to price looks at the physical assets mainly. So those are included in the book value, but because we have quite conservative accounting rules for intangible assets, so intangible assets typically are not actually included in the book value. Okay, so instead, if a company invests into intangible assets, this is treated as an expense. And so the argument is that these book values are actually flawed. And so this is obviously an important question. Clearly, if you look at the economy today, it would be unreasonable to argue that intangible assets do not matter. They obviously do, but if you look at the accounting framework for dealing with intangible assets, even though there's obviously there's some exceptions, but in principle you have this conservatism, and so a lot of intangible assets are actually not included on balance sheets, so then they're not reflected on balance sheets, and this principle really hasn't changed, since the 1970s. So in a way, you could argue that accounting rules, they still operate in a pre-Microsoft world, right? So Microsoft didn't yet exist, so maybe we didn't yet know that intangibles, things like developing software, could actually be extremely valuable. But obviously these days everyone would recognize that intangibles would actually make up a significant fraction of firm value. So in our study, for example, we find that about 30% of firm value, firm book value, if you will, is made up of intangible capital. So clearly it's important to consider this, and this criticism of the book to market ratio, is extremely relevant, right? So it would be unreasonable to argue that we should just forget about intangibles. The question then is, once you recognize this criticism, the question then is, so what do you do? What do you do about this? And there's basically two approaches that I list here. The first approach is the standard approach of index providers. So index providers, explicitly argue that this this omission of intangible capital in the book value is a problem, and so their response to this problem is to not just rely on the book value, but instead to combine different accounting ratios. Okay, and so what they state is that by combining different accounting ratios, they avoid to rely on the book to market ratio alone. Now, this may seem like an odd way to address the problem because, what is the problem? The problem is that these book values, they omit something that should be in there. They omit intangible capital. So the direct answer would be to say, well, then let's include intangible capital in the book value. Instead of relying on the reported book values, let's actually adjust those book values to, and let's try to measure them better to also reflect the intangible capital. Now, this is an approach that has been proposed by academics. So there's a number of recent papers. I just cite 3 of them here. So papers that were published over the past 3 or 4 years, and that show that you can actually measure book values better by actually including intangibles. Now, this actually goes back to a lot of work that has been done in accounting, where accountants try to figure out how to actually measure the intangibles. And it also goes back to a lot of work in economics. So in the economic administration, economic statistics, for the national accounts, economists are interested in figuring out firm capital. And there's actually a lot of literature, and economists have actually estimated intangible capital to include it in these numbers for quite a long time. So these are really 2 very different approaches, and the objective of our research was really to compare these alternatives when you define the value factor. So this is our question. Now, I just want to be clear also about our objective. Now, our objective is not to identify the true value of a stock. So you do hear statements, sometimes criticizing book to market as a value metric. And these statements sometimes argue that the book value doesn't reflect the true value of a stock. Now, in this research, we're not at all interested in identifying the true value of a stock. So obviously, identifying the true value, that would be a very ambitious goal. And even if you adjust the book value, you're not going to identify the true value of each stock in a precise manner. That's actually not at all what we're trying to do. What we're just trying to figure out is what is a good classification of a stock as a value stock, and then including lots of value stocks in a well-diversified portfolio should hopefully give us access to the value premium. So this is a much less ambitious question than figuring out the true value of a stock. And it's probably misleading to sometimes qualify the value factor as something that tries to identify mispriced stocks by comparing market value to a measure of intrinsic value or true value. So this comparison to true value is clearly what active managers do, but it's not something that you could reasonably expect from a systematic strategy. It's not reasonable to think that based on any combination of accounting ratios, you would get a precise measure of the true value of a stock. And in fact, the true value will depend on lots of other parameters. And actually, if you had 2 stocks with the same accounting ratio, okay, whatever it is, whether it's book to market, whether it's earnings to price or any other ratio, one stock could have a much lower ratio and still be overvalued, whereas another stock could have a high ratio and not be overvalued. So luckily for active managers, luckily for financial analysts, we're not going to figure out what is the true value of a stock through a simple systematic analysis, with accounting ratios. Okay, so that's just to clarify the objective. So our objective is not to identify true value. It's simply to identify the value factor. And so before going to the analysis for the value factor, let me just recall what the criteria are for identifying a factor. So this is really important, because before going to the concrete application, let's just ask what are actually the requirements. And you're probably familiar with different lists of requirements of what should be called a factor. The idea of a factor is that you actually get a reward for holding long-term exposure to this factor. And so the first requirement is that there should be a long-term reward. So you could go to long-term data to figure out what the reward is. So importantly, this must be a reward that is not just reward for bearing market risk, right? So this is also what you call a CAPM anomaly. So the returns to a given factor, they should not just reflect the compensation, the fair compensation for taking exposure to market risk. They should actually reflect a long-term reward beyond this compensation for market risk. Now, also this reward should not simply be a repackaging of factors that we already know. Okay, so it could be that let's say a new type of value factor is simply exposed to another factor that we already know. So it could be exposed to the size factor, it could be exposed to, let's say, the low risk factor. So if the exposure to these other factors, fully explain the reward, then there's really nothing interesting in that in that new factor definition. So this criterion is also called the non-redundancy. So a factor should just not simply be a repackaging of already known factors, and this is a really important criterion. And then finally, looking just beyond returns and just looking beyond analyzing historical returns, there also needs to be a rational explanation why this reward is there in the first place. Okay, so typically we expect that there is a reward if investors hold exposure to systematic risk. Okay, so if a factor actually delivers losses in bad times for investors, okay, in times when actually the marginal utility of consumption is high, well, those are actually the strategies of the factors that should deliver a risk premium. Okay, so for taking on this risk, investors would expect a compensation, and this rational explanation is also what gives us some confidence that this reward should persist. Okay, if we just find some new factor in the data, it looks fantastic even over the past 30 years. Well, once that gets published, this should not continue to persist unless it is a reward for taking on additional types of risk. So any factor should fulfill these criterion, and this is, I think, sometimes forgotten when product providers launch, enhanced factors, improved factors. So we should really go back to these requirements, and any improved value definition should also fulfill these requirements. And so this is exactly the focus of this research. So this is exactly the angle that we're going to take to analyze the different types of value factors. So again, we're looking at two alternatives. One is an intangible adjusted book to price factor, and the other one is to look at these common industry definitions. So we're going to take a composite of a bunch of valuation ratios. So how can we go about adjusting the book value for intangibles? Well, intangibles are not included in the book value precisely because they're not that easy to value. So how can we actually go about adding back intangibles? Also, intangible capital is missing from the balance sheet, right? So how do we go about actually adding it back to the reported book values? So there are actually two types of intangible capital. So first of all, there's knowledge capital, and then there's organization capital. Now, knowledge capital is really reflected in the know-how of a company. This know-how can lead to better products. Okay, if, for example, you have a biotech company, the biotech company may develop know-how that could lead to new diagnostics, new treatments, could lead to a vaccine, et cetera, et cetera. So this means this know-how can be embedded in products and then generate value. But the know-how could also be embedded in improved processes. So this could, lead to more efficient way of producing, let's say, already known products. So this know-how could be reflected in and kind of protected by patents, but it could also be other forms of know-how. So a classic example here would really be a biotech company that invests very heavily in research and development. Now, how do we come up with estimates of knowledge capital? Well, we can simply go to the research and development expenses. So these expenses are reported. They are not actually, they don't actually appear on the balance sheet. Okay, and so what we're just going to do is we're just going to capitalize these R&D expenses. And again, there is, there are methods that are used by the Bureau of Economic Analysis to actually estimate this knowledge capital from R&D expenses. So typically, you're just going to take the current R&D expenses, and then you're going to actually depreciate these R&D expenses over time. So we have access to published lists of depreciation rates that we could use, which will depend on industries. And so this, just following the standard method, will allow us to estimate this knowledge capital from R&D expenses. Now, the second type of intangible capital is organization capital. So here you can think of a different type of company. You could think of a consulting firm, for example, say a strategy consultant. So the organization capital is really the reputation of the firm, obviously the consultants, the workforce working for this firm and their skills, and obviously also the customer relationships, right? So it's maybe not so much about generating new knowledge with R&D. This is a different type of intangible capital. How can we estimate this organization capital? Well, again, there's a standard approach, which is to look just at the overhead, so the selling, general, and administrative expenses. So looking at these SG&A expenses, a common approach is to take part of these expenses and basically assume that, well, this is actually something that is used to train the workforce, to invest in the brand, to invest in customer relationships, and then just like the R&D expenses, this can be depreciated over time. So we follow really a standard approach here to actually measure these forms of intangible capital. Obviously, you will get different results if you use different, let's say, different depreciation rates. But the results are quite robust. You could argue that any kind of measurement of intangible capital, is somewhat arbitrary, and so it's maybe better to leave it out. But what we would argue is that any estimate will still be much better than assuming that both knowledge capital and organization capital are effectively zero. And we've also shown in results that any of the empirical results we get do not at all depend on the precise assumptions that we make here. So this results are quite robust to these measurement issues. Now, so we're able to account for intangibles, but a question we need to ask is, why should we actually do it in the first place? And there's basically two reasons for that. The first one is because intangible capital actually gives rise to risk. And in that sense, it's very similar to physical capital, right? So you could, if you go back to the rationale for the value factor, the rationale for the value factor is that firms that have a lot of assets in place, okay, so typically a lot of physical capital, will actually tend to be more risky because they will have problems reversing these investments in bad times. Okay, so they're basically stuck with a high capital stock in bad times in an economic downturn, and so they will generate lots of losses. This is opposed to growth firms that have a lot more flexibility because they have a much lower capital stock. So the question then is, what about intangible capital? And what the literature has shown is that intangible capital, is actually very similar to this question of physical capital. So intangible capital also gives rise to risk. So investments in intangibles are costly to reverse. And you can look at different examples. So if you think about organization capital, it's been shown that organization capital also exposes firms to a risk of generating losses in bad times. So the reasoning here is that organization capital is actually related to human capital. So since we don't have slavery, that also means that this human capital doesn't actually entirely belong to the firm. So if the firm has key talent that is very important to the value of the firm, that key talent can leave the firm. And it's been shown, for example, that if you take a firm with financial constraints, when these financial constraints bite, key talent will tend to leave the firm because key talent will have more opportunities elsewhere in firms that are less financially constrained. And so this leads to a tendency that when financing constraints bite, so those are bad times for the firm, key talent will tend to leave, and this will actually damage the organization capital. So that also means organization capital is risky, and so firms with high organization capital should actually expect to be more risky. You can make the same reasoning for knowledge capital. So if you think about an R&D project, if a firm is invested, say, developing let's say a set of diagnostics, and it has done 2/3 of the R&D, then is under financial stress and has to abandon that R&D project, well, it's not going to get the benefit of the last third of the research, but above all, it has also wasted resources on developing that research to 2/3 of the finalization, and so there will be large losses under financial stress. And so again, this means that these firms are risky. Another reasoning is behavioral. So factors could also be justified by behavioral biases. And so it's been actually shown that investors will also have a tendency to underestimate opportunities related to intangibles. So for example, if you take firms that have a low market cap, but a relatively high stock of intangibles and continue to invest in these intangibles, that signal is poorly understood by investors with behavioral biases, and so that could also justify why the value definition should actually consider the intangible capital alongside physical capital. Now, our objective was really to compare this, let's say, this approach of an intangible adjusted value definition with common approaches in the industry. So again, the industry approaches typically combine different accounting ratios. So what you see here is a set of different accounting ratios and how they actually perform. So this is just long short factors, and we look at annualized returns. And you can see here why in the industry some of the alternative definitions are popular. So if you look at the book to price ratio, so this is a period here starting in the 1970s, so long-term US data. The book to price ratio leads to a value premium of about 2%. You can see that some other definitions like sales to price and earnings to price lead to much higher returns. So this is probably a reason why some providers prefer moving away from book to price, and so instead use other accounting ratios. However, this picture really doesn't contain a lot of useful information for investors. Why? Because this is purely a standalone perspective. So do you know of an investor who has the choice to either invest only in the risk-free asset, only hold cash, or invest 100% in a value portfolio? That's not at all a typical question, right? So the standalone performance of the value factor is really not the relevant question for investors. Instead, we need to go back to this question of redundancy. So what does the performance look like when you actually adjust these different factor definitions for the overlap with other factors? Okay, so in the remainder of the analysis, we will focus quite heavily on overlap with other factors. There are two reasons for that. So the first one is, well, we simply want to avoid ending up with this famous factor zoo. So we could obviously test, not just 4 or 5, but probably 40 or 50, and even more different value definitions. We have lots of different accounting ratios that we can choose from, and we can also make small adjustments. Just think about earnings to price. Just use your favorite definition of earnings, and there'll be many of those, and so we can have a lot of different variations of earnings to price. So, and a lot of these could outperform. Okay, so we would tend to end up with just a zoo of value factors, and that's not going to be helpful. Now, more importantly, what we're interested in is to identify the value added for investors. Okay, and the value added for investors is not this standalone return. Again, I don't know of any investor who's hesitating between either the risk-free asset or 100% in value. Instead, investors hold well-diversified equity portfolios. These quite often contain many different factors. And so a value factor that is a new and improved value factor, but actually has a large overlap with other rewarded factors, will not improve the performance of an investor. So what we're really looking for is a value definition that generates unexplained returns. Okay, so these standalone returns are not meaningful because part of the returns may be explained by exposure to other factors. So we need to use unexplained returns from these multi-factor regressions. So what are the returns once you adjust for exposure to other factors? And that's really the key focus of our analysis. So I'll just show you a summary of some of the key results. So the research that I'm presenting here has been published in July in an article in the Journal of Portfolio Management. So you can access this article. There's also quite a substantial appendix to the article. So there's kind of lots of results, different robustness tests. I'm just focusing here on the key results. So what happens when you look at unexplained returns? Well, think back to the standalone returns. Things like sales to price and earnings to price look very attractive, much higher returns than book to price. Once you adjust for the exposure to the other factors, okay, and here we're just looking at the typical 6 factors that equity investors consider. Once you adjust for all of these factors, you get a very different picture. So sales to price doesn't add any value. You can see the red bar, this unexplained return is actually negative. We can also see that for earnings to price, this value added to a multi-factor investor is actually very close to 0. And actually, significance here is indicated with a like deep red coloring, and insignificant results are light red. So you can see that none of the alternative value definitions actually has a significant value added. The exception is the intangible adjusted book to price ratio. So that's actually the only one that adds value beyond what you could get from implicit exposure to other factors. We've also considered the actual factor exposure behind this result. And one of the very strong drivers of this result is the profitability factor. So you will see that a lot of alternative value definitions have strong exposure to the profitability factor. That's the case, for example, for cash flow to price and earnings to price. That seems to make sense because obviously, high earnings, high cash flows, will be associated with high profitability. And so after you adjust for this profitability exposure, you don't actually see any value added in this long-term data. Again, what is the implication of these insignificant multi-factor alphas? Well, the implication is that you do not add any value in a multi-factor portfolio through these alternative value definitions. So if you think about the Sharpe ratio of an investor who holds a set of different factors, there will not be any improvement if you don't have a positive unexplained return in the multi-factor regression. So this is what we look at here. So we're looking at the Sharpe ratio of a portfolio that has exposure to both the low risk and profitability factor, and then also adds a value factor. Okay, so these are just equal weighted multi-factor portfolios. We can see that the Sharpe ratio of the book to price portfolio. So this has the three factors, but the value definition is book to price. The Sharpe ratio is 0.8. So if instead of using this simple book to price, you use a composite definition, you can see that the Sharpe ratio actually decreases. Okay, so there's no value added for investors in these composite definitions that are used in the industry. Okay, and that's if you assume that investors hold multiple factors. However, we see that the Sharpe ratio increases quite drastically when going from the book to price to the intangible adjusted book to price. So the Sharpe ratio increases from 0.8 here to 1 in our long-term US sample. Now, this suggests that the intangible adjustment is quite attractive and has a positive influence on the value premium. And on the other hand, we see that these definitions commonly used in the industry, based on combining different accounting ratios, actually don't add value in terms of improving the value premium. Now, in addition to looking at performance, we would also like to look at risk. Now, the question with any factor definition is, well, you see performance in the data, but do you have reasons to believe that this improvement will be persistent? Okay, and so to get some comfort and get some conviction that this could be persistent, you would like to see that this improved return is associated with risk, right? So that investors take on additional types of risk and they get compensated for this with higher performance. So we're looking at different definitions of riskiness of the value factor. So one of the common explanations actually of the value factor is that there's a strong link with operating leverage. So companies with high operating leverage, if you will be more sensitive to economic conditions, and so as their revenues will vary, this will have a bigger impact on the earnings than for company with low operating leverage. So we can see here that the book to price based value factor is quite strongly exposed to this operating leverage. The intangible adjustment actually increases the riskiness of the value factor. So that suggests that this performance benefit has an explanation, which is that there's actually increasing risk, and this factor nicely aligns with the classic, or one of the classic explanations of the value factor, that investors get compensated because they hold firms with higher operating leverage. You can also see that some of the popular alternative metrics used in the industry, they don't align at all with a risk-based definition. So you can see that if you use cash flow to price or earnings to price, your so-called value stocks will actually tend to have lower operating leverage than the growth stocks. And that's actually the opposite of one of the key economic explanations of the value premium. So again, here there's a strong advantage of this intangible adjustment. It leads to alignment of that value definition with really the classic risk-based definition. We also looked at a different type of risk. So one of the explanations of the value premium is that value firms tend to have more risky earnings, so that you can see that the risk of the value firms in sensitivity of their earnings to economic conditions. So we're also using here a measure of sensitivity of the earnings to aggregate supply in the economy. And again, we find that the intangible adjusted book to price leads to the conclusion that that value stocks are riskier than growth stocks. So this remains a risk-based value factor. And again, this doesn't appear for a lot of the popular definitions like earnings to price or cash flow to price. So the intangible adjustment doesn't lead only to improve performance, but also aligns with a risk-based explanation. So conclusion of this study, again, at the outset, our idea was to compare two types of alternatives to the classic value definition, so to the traditional price to book. The first was to include intangibles and adjust the price to book. The second one was to move away and use a composite value definition combining different ratios. So the results clearly suggest that these composite value definitions do not add value in a multi-factor world. Then you might ask, well, how did the industry come up with these value definitions in the first place? So a reasonable explanation is that a lot of these composite value definitions actually came about in the 1990s. So back then, investors didn't have access to these explicit factor indices. So it was not common to have indices for factors like momentum, quality, low risk. And perhaps in this setting, it actually did add value to have a composite value definition. It basically gave you an implicit multi-factor index, right? Value plus some exposures to other factors. But in the current world, where investors have access to multiple factors in an explicit way, it's clear that these composite value definitions actually don't add any value. On the other hand, adjusting the book value for intangible capital leads to an improvement in the value premium and also aligns with a risk-based explanation. So when you hear statements that the book to market is outdated, I think it's important to underline that instead of moving away from book to market and forgetting about this classic value definition, we can actually do something quite simple. We just try to improve the measurement of the book to market ratio. We can improve how we measure book value by including intangibles, and that completely, if you will, reestablishes the value premium. Thank you very much for your attention.